Welcome, Dhirendra.
Thank you, Prem. Thank you for this opportunity, this annual opportunity.
Yeah, and no matter how much at value research, you keep trying to educate people. Why कई बार गाड़ी यहीं पर रुक जाती है, how to select a mutual fund. अब सीख लिया, लेकिन अब हमें ये बताइए कि म्यूचुअल फंड कौन सा लें. So एक चीज पूछना चाहता हूँ, and obviously this is a very valid concern because there are at least 1,000 open-end funds, and they are spread across 30-40 categories. Okay, so how does one go about the task? Which should be the first task when you start looking for a fund to invest in?
Yes, if you look at 1,000 categories and if you have to look for 1 or 2 or 3 or 4 or 5 funds, then it looks like a very difficult task. But it is actually not. If you first decide that the time frame, and if somebody is advising you, and if he's actually trying to figure out that, it does not require trying to figure out. If you're a first-time investor, if you have ever invested in any market-linked investments, your category gets narrowed to 1 or 2. In fact, 1 or 2 kind of fund will actually fulfill your need. And after that, the job gets easy. You have to choose 1 or 2 funds from that category, and that is good enough. So,
which category is that?
If you're a long-term investor getting started, never invested before, even an aggressive hybrid fund or a balanced advantage is good enough. If you have, looking for a fixed income avenue, never invested before, don't go anything beyond, short-term fund. So, narrowing your category, keeping it simple will, help you start quickly and with reasonable confidence without any disappointment.
Okay, so you're saying if you have no experience, start with an aggressive hybrid fund, a balanced advantage fund. If you're looking for a debt fund, where presumably you do not want to take any risk, then go in for a short-term fund.
Yes.
Is that correct? Okay. Now, what filters should investors apply before selecting a scheme? एक तो बता दिया, 2 आपके implicit थे. एक तो if you don't have experience, stick to. दूसरा आपका implicit था, if you do not want to take risk, stick to debt.
No, I was saying that long-term and short-term. And long-term and short-term, I would...
Long-term, short-term.
Yeah. So, long-term, I would define it as, a lot of people think that, long-term could be few months, few years. How many years? I would say 5 years. Just have a hard, just have a numeric thing so that your policy, your mental mechanism becomes clear. That anything within 5 years, I would call it short-term, medium-term.
Okay. Now, Dhirendra, there are a lot of ratings which come out. How important is ratings at the starting point?
It is useful. The way I use my rating is that, I don't use it as a, I don't start with my 5-star and 4-star fund. That it is, but ignoring the 1-star and 2-star fund, it's a filtration. It plays a filtration role for me. Dropping a large number of 1-star, 2-star fund, because they are, if you ignore the low-rated fund, you can be sure that you will not get into chronic debts, which they prove to be. You also have a large set of no-go categories. Most investors can, what I was saying earlier, if you avoid many categories, that will, sectoral funds, thematic funds, because keeping it passive, keeping it what you come to mutual fund for, which is diversification, professional management, and these are all reverse of that. The moment you get into a thematic fund or a sector fund or any such exotic thing, you are narrowing your choice, and you are paying full service fee for a very limited service.
Okay. Now there's supposed to be 3 broad categories in mutual funds: equity, debt, and hybrid. Okay. Now, what will be the principles which should guide fund selection for each category?
As I was saying, that your immediate term, something which you need in the foreseeable future, that is debt. Money for 5 years and more, equity. And then investors who are conservative. There are people, India is a fixed income country. Everybody has been doing fixed deposits and things like that. They have never invested in anything which is linked to market. If at all they have invested in a very seasonal way. Once in a while, they drift into the market and invest in something, get disappointed. So, those scared kind, they should always start with a hybrid fund. And hybrid fund, a lot of times people think, because mutual funds are sold on performance. So, they don't get the respect. But, when risk visits you, that is the time when, they don't crumble, they don't collapse, and they come in very handy. So hybrid funds are meant for long-term investors wanting to have a steadier take on growth in whatever form. When I look at the conservative hybrid fund, they are meant for people trying to seek, beat inflation with a very modest equity allocation. Aggressive hybrid fund, long-term, investment, but without the kind of, jerky experience, roller coaster ride of an all equity fund. So that's the purpose. That's the experience.
Okay. Now, so time, liability, and goal. Does goal play a role in the fund selection process? If my
Yes,
goal
it does,
is
because
retirement.
how far that is the time, because how far is your goal per se does not play, because your child's education, if it is 2 years away, it's different. If it is 18 years away, then it's completely different. Time frame do. There is another thing. There are goals which is needed 4 years away, and it is a non-negotiable goal. And then there are goals which are negotiable. You can do it in any time frame, 4 to 7 years. Things like that. If you plan to buy a house, it will be a goal like that. But if you looking for a child's education or the date of retirement, if you're in a job which actually you're supposed to you will retire on a specific date, and you have to rely on income from your investment, then it is a non-negotiable thing. And so yes, time frame matters, goals matter, but negotiability and non-negotiability also matters. That determines the goal time frame.
That's very interesting. Perspective that you brought to it. Now, a lot of times, personal finance articles say that look at the quality of the portfolio of a scheme before investing in it. And I find that to be a kind of a funny thing, because if he could understand the quality of a portfolio of a scheme, then he would probably be a stock picker himself.
Yes.
Just because the name is familiar does not mean that it's a good quality stock, because for very naive investors, not experienced investors, that's probably the point which start with. A very well-known company could be, highly overvalued. So how do you decide? Is this piece
I
of
completely
advice
agree
worth
with you.
following?
I completely agree with you, Prem, and I've been quite dismayed by this. When you look at the portfolio of any fund, any kind of fund, equity, debt, you are only taking a snapshot view. And let me give you something which will reinforce this what you are saying, and investors must understand this. When you look at the best performing fund, Indian fund, over the last 10-15 years, and the worst performing Indian fund, the portfolio on a comparative basis will look alike. And so you will actually not find the reason. That is the funny part. You will find the same 10 big names there as part of the portfolio. So you will just be thinking that what has gone wrong? What has gone wrong could be mistiming. What has gone wrong with the lack of discipline? Maybe the fund which is doing poorly, is actually trying to catch up. It tries to pick things after it has gone up, and ends up buying high, selling low. Maybe it has a long tail. So there could be plenty of a lot of things to it. I would say that if you have to look for a high quality fund, it should get reflected in 10 years return, and high quality fund should get reflected in consistency of return. And then looking at the portfolio is not is a meaningless exercise for exactly the reason I was mentioning.
Okay.
In case of fixed income, there could I would just like to I'm just applying my thinking here that in case of fixed income, it could be a little different, because unlike equity, which is there for perpetuity, fixed income expires. It has a limited life, and the rating of the fund is a very quantitative. determinant of, its quality. That is what it is. It is the credit quality. It's an opinion on the credit quality, which also governs the return on that fixed income instrument. So in that sense, that could be relevant. And that is something which we have democratized that information. You can look for that funds page on Value Research Online, look at the credit rating split, what percentage is in which kind, sovereign, AAA, AA, so on and so forth. Then we also, based on the different weights, we also compute the average credit rating, assuming that the whole fund was a single bond, what it will be. So that gives you a reasonable sense. But in case of fixed income fund, having a negative threshold that, you will never invest in a fund which is X% more than in lower rated, and you can define your lower rated, that I think will be useful. And that is something which an investor should do. That is what your advisor should do.
Okay. While we are on the subject of mutual fund selection, there are some questions which have come to me which are somewhat related to our discussion. So for small cap funds, this is a question from Vipul Pandey. The smaller the aim, it's more likely for a fund to do better. But these funds have certainly become larger in AUM. What to do now?
They cross a basic threshold, and for me the threshold is 2,000 or 2,500 crore, and start looking for a new one.
Start looking for a new fund if the existing fund has crossed an AUM of 2,000.
In case of small cap, because there is a very unique Indian problem. Indian companies, there is a the promoter is still they hold a large part of the outstanding shares, and looking for new ideas beyond a certain point, one has to be successful with many things to be impactful in a small cap fund. So I think a better choice will be to look for a new one.
Okay. Now, if someone's looking to start with an SIP of 15,000 per month, how many funds should he be invested in?
I think, as I was saying, that depends on his experience so far. If he's going to invest for the first time, he should start with 2 balanced advantage funds. That's it. And maybe move to an aggressive hybrid fund 3 years from now. Because all said and done, you can't teach anything about volatility by any classroom, any of my lectures or anybody's lecture. One has to really experience it. Once you see that your investment have gone down in value by 30-40%, it's way too disappointing for somebody starting. So 2 funds first, and maybe 1 fund for a experienced investor. There is a great value in keeping it simple. One value is that you work hard to choose a good fund, and then you remain interested. The moment you actually have 6 of them, then you think that thoda na paisa laga hua hai, koi baat nahi, it doesn't matter. You get little careless about it, which is not a very desirable thing. Be sure about it and choose a good fund. Be knowledgeable about it. Keep track of it, and don't be on the lookout to jump that fund up for underperformance over a brief period of time, because the finest of fund go through some phase of underperformance often.
But there's one question which is related to it by Vipul Pandey. How to get rid of bad performing funds, especially when they're doing badly in comparison to their peers? Before redemption, how much time should we wait?
Here also, I don't have a straight answer. I will give answer, but I'll give you the understanding that why I don't have a straight answer. If the fund was doing well, that is why you started investing in it in the first place. And if that fund has lacks a long history, don't give it much time. 2 years, get over it. If it is a fund which has a long history, I will be giving it an opportunity. And if it has a long history of doing some brilliant thing in the last 10, 15, 20 years, I'll be patient for 4 or 5 years. And there is a reward for holding such a fund, because when you keep investing through the lean period of a fund, and when it starts doing well, I would like to find a fund, if there was a way to find one, that look for a fund which will do so poorly over the next 10, 15 years, which is my period of investment, and do exceedingly well just before I need the money. But hard to find one. But a good fund, experienced fund, I'll give it 5 years.
Okay. And now there's another question from Nitish. He's asking, market is at an all-time high. What should be your suggestion for the retail investors? Should we be looking at index funds?
These are two unconnected things.
Okay.
One is that, market is at an all-time high. And when the market is at an all-time high, it goes up a little bit, it achieves a new all-time high. And so, market has been in the vicinity of the all-time high for the last one and a half year. And quite unexpectedly, while we are witnessing, some unprecedented thing. That's a different thing. One is that, if you don't have the time on your side, scale down. Maybe take your money out. If you need the money in 2-3 years, we are very lucky to actually have, seen this kind of all-time high. Take your money off the table. The other is that, if this is still long-term money, and so and you have no asset allocation plan, you have been, you are fully into equity, devise an asset allocation plan, you will have less regret. And you will also get a rebalancing opportunity if you're right about the, market at an all-time high and it corrects. The third is that, if it is, if you somehow accidentally drifted into the market and it was a short-term money and you have been lucky so far, then take your money out and feel happy about it.
Okay. Okay. Now I have 2 more questions before we wind up the session. One is a question from Krishnamurthy GM. It's a very simplistic one, but I don't know if the answer can be simple. How many years do we need for good returns?
How many years?
Yeah.
Okay. We did this exercise some time ago, and we realized that, if you hold your investment for about 6.5 to 7 years, you always, because, good return means I have a threshold of, a good return. If I'm able to beat inflation with my investment by way of SIP, because that is a natural mode of investing, that I would say that is the basic threshold. If I'm able to match the fixed income return, that is my opportunity cost. Nothing happens, I can go to a friendly neighborhood state bank and do my recurring deposit. That is my opportunity cost. So anything which is beating this by about 5-10% over the next 5, 7, 10 years, or maybe, even public provident funds. So that you will find that on Value Research online. You put all your investment and you can compare it with a PPF corresponding investment or a market corresponding investment. So I would say that 6.5 years is the time frame when if you pick the worst time in the market, and if you got out at the worst time in the market, the rolling return over the 6.5 year period was the one when you never lose money compared to these two.
Okay.
But that is past. I don't know about the future.
Okay. Okay. So it comes with a caveat. Past performance is not done. Yeah.
Yeah,
okay,
yeah. One should never forget the statutory disclaimer at all times.
Okay. And there's a final question that we will take from Ashish Kumar. He talks about insights on ESG mutual funds. Is there a case for ESG funds?
I hold a very cynical view about ESG. That it's the definition of ESG is not very standardized. One can also torture the definition to confess to something, and one can also have a liberal objective or the mandate whereby a certain percentage to whatever allocation, and you can be ESG compliant. And even the people who are giving the ESG certifications, they have a different kind of definitions for something to be ESG compliant. So it's an interesting thing, and I think in overseas market they have relevance. In India, if you look at the compliance, if you just avoid 2-3 sectors, you will be reasonably compliant.
Okay. Okay. Thank you, Dhirendra. We have run out of time, and thank you for sharing.
Thank you, Prem, for this opportunity.
And as always, this was very enlightening, and we always get to learn something new whenever we talk to you. So thank you for being with us, Dhirendra. Okay.